Hi, Andy Nybo, Principal and Head of Derivatives here with Satyam Kancharla of Numerix. And today we're going to be talking a little bit about analytics and risk and its impact in today's market and what firms are doing on the sell side, the buy side, to manage the changing environment. So welcome. Thank you for agreeing to do this video today.
Hi, Andy.
I'd like to, I guess, start with, we have all these new regulations coming into play, Dodd-Frank, EMIR, MiFID. Lots of changes in market structure, lots of things going on that are changing the way the buy side and the sell side approach the business. What are you seeing from your client base in terms of what they're doing, the types of analytics, the types of risk products they're looking to use, and how are they adapting to this new regulatory environment?
Well, if you look at the changes that you mentioned, the regulatory changes and the changes in market structure, they really impose certain restrictions on certain types of flow, and they incentivize certain other types of flow. So really, the way I think about it, the rules of the games have changed, and particularly as it relates to derivatives, how the players in this market engage in the marketplace and how trading activity happens. There have been a number of changes with the introduction of SEFs, with the introduction of clearing as a mandated policy, and bilateral margin trading as well. What's happening is a number of additional costs are coming into the picture, whether it's for collateral on a bilateral margin, or it's initial margin and variation margin for a cleared transaction, or really basis spread or basis risk in terms of being restricted to use a certain set of products or a certain set of standard products as opposed to using more bespoke and tailored hedges. So the need that many of our clients have is really to bring all of this onto one basis and really allow them to make decisions that are adjusted for all these effects, adjusted for all these regulatory changes and Basel III, Solvency II related changes, and really put everything on the same basis so that trading decisions and risk decisions can be made effectively.
Are there challenges they face? And I mean, obviously, with different systems, with different streams of data, different inputs coming into their risk systems, their analytic systems. What are the challenges they face, and how do you solve for these challenges in real life for a client? What are they doing to kind of adapt and manage these problems?
I think the bane of creating change in all these areas has been really the fragmentation that we typically see in an enterprise. An enterprise architecture as a whole needs to be revisited to really do this right. Whereas in the past you had the front to back flow, business by business, and the different businesses really not connected with each other, or not really having analytics on the same basis. Same thing with front office and risk fragmentation, and really data and analytics siloed across these different desks. A lot of instances, analytics developed for a single purpose that help for trading, let's say, but do not lend themselves to risk analytics or vice versa. So the main effort for institutions to really implement these changes is to cut down the silos, get the data architecture in place, and then put together an analytic infrastructure or an analytic foundation that could then be used to build other applications on top of these fundamental fabrics, to have consistent analytics across the different business lines, so that business level optimizations can be done, or collateral optimization can be done, and that consistency is an effort that has to be done from the ground up.
We were talking before about the challenges with different pricing mechanisms, with initial margin calculations that may or may not be included in prices. What are some of the other challenges facing the buy side or the sell side as they adapt to this new market structure and this new trading environment with pre-trade clearing costs that need to be disclosed? Mm-hmm. What other things are kind of showstoppers that are stopping them from expanding their activities?
Yeah, it's really more optionality, let's say, in terms of what a trader needs to do or what a business needs to do. There are more options for the trading venues with multiple SEFs emerging. There are more options for clearing versus non-clearing. And also in terms of using different products or different mix of products for hedging, there's more optionality. So that optionality really means that there are multiple levels of decisions that need to be made for someone who's operating in the derivatives business. Futurization of swaps is another trend. So in this area, therefore, this optionality creates a lot of complexity for someone who is operating, whereas in the past they might just call their banker and say this is what exactly they need. They have many more options now, whether they're on the buy side or even sell side, tier ones, tier twos, on how to optimize the business, and that is the optionality that needs to be understood and dealt with in the right way.
So those are some of the challenges, some of the obstacles they face. I'd like to ask one more question about opportunities. Where are the new opportunities? Where do you see growth? Where do you see risk and analytics providing an edge and allow a firm to leverage their capabilities?
So in the last few years, we've seen some uncertainty around regulation, and the good news is a lot of the regulation is starting to settle down. There's clarity that's emerging, and tied to that is really the opportunity. So there are a number of players who are moving ahead with implementing these changes, and ultimately the business of managing risk and allowing your customers to gain return and effective hedges, etc., is still a relevant business. But how the business is done is very different. Many banks are providing additional ancillary services to their buy-side customers, as we all know, whether it relates to collateral management, whether it relates to hedging. And on the other side, looking at buy-side firms, large buy-side firms, they are developing banking-like operations or in-house hedging operations that allow them and give them the advantage they need and operate in the new environment in a more effective way, in a more successful way, and make sure that all the costs are being incorporated in the right way. All the regulatory effects are being incorporated in the right way, so that they're positioned for flow, positioned for trading and services around the trading that many institutions are offering and continue to expand to offer.
Oh, great. Well, thanks very much again, Satyam Kancharla. I appreciate your time today. And again, Andy Nybo, Head of Derivatives here at TABB Group. Thank you.
Thanks, Andy.